The webinar will begin in 1 minute. Welcome, everyone. We are pleased that you have joined us for today's webinar titled Taxpayer Beats the IRS in Split Dollar Case. The webinar will last approximately 20 minutes, and at the end, you will be given an opportunity to receive supporting materials by email free of charge to you. You will also be told how you may email questions related to today's content to the presenter. Today's presenter will be Linus Sugis. Linus is the president of Advanced Underwriting Consultants. He and his team answer tax and technical questions posed by producers every day. Linus also spent 14 years working in the home office of a life insurance company in various roles. He also started, ran, and sold an estate planning law practice in the Nashville area. Linus will draw on his legal and life insurance experience during today's webinar, and here he is.
Thank you, Amber, and welcome everyone. I'd like to thank you for joining us today. I'd also like to apologize for those of you who may be on the call or maybe listening by recording. We scheduled this webinar on the Yom Kippur holiday and didn't mean to do that, but since it was kind of already out to everybody, we decided to go ahead and record anyway. So my apologies to those of you who are observing the holiday. Let's go ahead and get started. Let's talk about taxpayer beating the IRS in a split dollar case. But before we do that, let's talk about our next topic, the topic that'll be coming up in November. We have these free webinars the first Wednesday of every month. Next month, it will be Wednesday, November 2nd at 11 o'clock Central. The webinars are free and open to everybody who is in the financial services business to the extent that they want to listen. We would welcome anyone. But we've got three choices to pick from next month. The first is case study, business continuation in the Denver Broncos. Second choice is what to know about gift taxes. And the third choice is Stoli is still dead. Let's go ahead and we will open the poll and give you the opportunity to vote. Go ahead and cast your vote for next month's content. Give you another couple seconds to vote if you haven't yet voted and you want to. I am going to go ahead and close the poll, and next month we will be talking about the Broncos, seeing that the football season's underway. I think it makes a lot of sense. Business continuation in the Broncos. Thank you for voting there. Well, so let's go ahead and get started on our topic for today. Taxpayer beats the IRS in a split dollar case. We'll spend about 15 minutes talking about this. It's a pretty technical thing. And so in 15 minutes, we're going to cover a fair amount of ground, at least at a high level. We'll briefly review split dollar and its taxation. We'll talk about the difference between employment-related split dollar and private split dollar. And we'll talk specifically about the court case, the Levine case, and its multi-generational split dollar implementation and what the decision in the case might mean for those of us who might present a split dollar to our clients or those of us who are administering split dollar plans that are in force for our clients. So let's go ahead and start with a bit of a review about split dollar taxation. In 2003, we got final regulations on split dollar taxation. The IRS spent a few years kind of going, back and forth with some details about how split dollar was going to be taxed. And they came up with those regulations in 2003. And those regulations are in effect for split dollar plans that were either entered into or materially changed since September of 2003. And the brief summary is that there are two ways in which split dollar arrangements may be treated for income tax purposes. The first way is the loan regime, and the second way is the economic benefit regime. So those are two distinct ways that business-related split dollar plans can be treated for income tax purposes. Well, what's the difference between the two regimes? Well, under the economic benefit regime, usually the way that it's designed is that the business pays most or all the premium for the life insurance policy, and the business owns all of the cash value. And basically the business enjoys the growth. The employee and the employee's family get the death benefit protection associated with a permanent life insurance policy. And the business pays for its portion of the premium with after-tax money, just like it would for key man insurance. And the employee recognizes an income tax result along the way, which is based on the value of the death benefit each year, based on the possibility that the death benefit might be collected. So it's like an ART, annual renewable term premium rate. Those rates are derived from an IRS table, table 2001, or they can be derived from the carrier's ART term rates if they've got a product that meets the requirements of the final regulations. The participating employee might pay extra income tax if there's any extra benefit other than the death benefit that might go to the employee or the employee's family. Like if any part of the cash value accrues to the employee's benefit under the economic benefit regime, they'll pay income tax on the extra benefit that accrues. So that's the economic benefit regime. The other regime is the loan regime. And under that kind of a configuration in a business circumstance, the business still usually pays most or all of the premium, but those premium advances are treated as loans. They're treated as loans to the employee, and to the either the loans have to accrue real interest that the employee is liable for, or the employee's got to pay that interest, or if neither of those is true, then the employee is going to pay income tax on the amount of loan interest that he should be paying. And so it's loan treatment for premium advances under the loan regime split dollar arrangement. The poster child for loan regime is the Jim Harbaugh compensation situation that we wrote about several years ago when he was hired by the University of Michigan. That plan seems to have worked out well for Harbaugh and provided an extra element of compensation to his plan there. And if you've got an interest in reading more about that, give us a touch after today's webinar, and we'll be glad to send you the article that we wrote on it. So that's it. In a business situation, economic benefit regime and loan regime, the design of the split dollar situation dictates what the income tax result is going to be. Now, we're talking in the Levine case specifically about private split dollar, and here's how that works generally. We usually use private split dollar in a two-generation family situation, and that is the older generation, the party that's trying to manage estate taxes usually, they act like the business. They provide the money for the life insurance policy. And the younger generation acts like an employee. And when I say the younger generation, it could be, one or two kids directly, or more often, it could be an irrevocable life insurance trust that acts on behalf of the younger kids. And so that's, those are the parties in a private split dollar situation. Think of the older generation as the business and the younger generation acting like the employee. And we've got the ability to pick to a certain extent whether we're going to use economic benefit regime or loan regime for any situation. But the difference, one of the main differences between private split dollar and regular split dollar is that we're trying to control gift tax results rather than income tax results. In a regular business split dollar case, because of the relationship between the employer and the employee, any transfer from the employer to the employee is going to be income taxable. But in a family situation, we're not worried about income taxes, we're worried about gift taxes, and therefore we're using the split dollar rules to control the gift tax results. And then usually in regular private split dollar, we're going to insure the older generation. It's the younger generation buying insurance on the older generation so that the insurance death proceeds are available to pay for estate taxes. That's the most common kind of implementation. Well, private split dollar is not always that simple. So let's talk about multi-generational private split dollar, which is the kind of split dollar that was the subject of the Levine case. Most usually we're covering, with insurance, we're covering the financing party, but that's not the case with multi-generational. What we're doing there is that the older generation is still providing the financing for the insurance coverage, but the older generation is not buying insurance on their own life or not paying for insurance on their own life. They're paying for insurance on the middle generation for the benefit of the middle generation and the middle generation's kids. And so that's why it's multi-generational private split dollar. And there's a whole different set of issues that come up in that context. And if you remember, or if you're familiar with the Morissette cases, those issues were the centerpieces of the Morissette cases. So in any event, let's talk specifically about what went on in the Levine case, tax court case from earlier this year. The planning party in the Levine case was Marion Levine, the matriarch of the family. And what Marion did is she created a revocable trust for to be the conduit for her overall estate planning. And at the same time, or shortly thereafter, she also created an irrevocable trust, which was for the benefit of her children and her grandchildren. They were all beneficiaries of the revocable trust. And Marion knew that insurance coverage was needed on the life of her kids for various purposes. And so what she did through her revocable trust is she entered into a split dollar agreement with the irrevocable trust. And Marion's revocable trust provided the money to the irrevocable trust so it could go and buy something. And the irrevocable trust indeed used that money to buy life insurance on Marion's children. And so the irrevocable trust was owner and beneficiary of the life insurance policy on Marion's children. Marion's revocable trust provided the money, and the thing that was needed to kind of complete the loop or the triangle in this case was that the life insurance policy was collateralized back to Marion's revocable trust. And under the split dollar agreement, Marion's revocable trust owned all of the cash, or at least had a security interest against all of the cash value of the policy. In the event of the policy's surrender or the termination of plan, Marion's revocable trust would capture all of the policy's cash value. So this was economic benefit, private split dollar with the multi-generational twist for those of you who are judging at home. So that's the deal. Economic benefit split dollar, private split dollar, and it multi-generational element because it's not Marion being insured under this, it is her children that the irrevocable trust is buying insurance on. So how did the court case come about? This part of it, even though it's a little bit complicated, looks straightforward. Well, what happened is that Marion died. And the issue became, what is that receivable that her revocable trust owns under the split dollar agreement? What is that receivable worth? Well, the estate tax return was prepared for Marion's estate, and at the time that of Marion's death, the cash value of the split dollar policies, and there was more than one, the aggregate value was about $6.1 million. Having said that, Marion's executor on the estate tax return claimed that the fair market value of the receivable was not $6.1 million, but was $2.3 million. And the IRS said, no, that doesn't work. We don't believe that the estate is entitled to a discount on the value of the receivable. We think the full value, $6.1 million, needs to be included as part of the value of Marion's estate for estate tax purposes. And so the parties ended up in the tax court, and the tax court was asked to decide whether a discount was available or whether the value should be $6.1 million. And that was the key question in the tax court. It was the centerpiece. And the tax court started its opinion by observing that the Cahill and Morissette cases had similar facts to Levine, in that they were both multi-generational split dollar cases in which the value of the receivable in the estate of the financing party was at issue. And under those two prior cases, the financing party had the right to terminate the split dollar agreement and get all the cash value back. And the courts in those cases decided that that power was important enough to make all the cash value includable in the decedent's estate. But the thing that Marion's trust and the ILIT had done differently is that they had expressly put in the agreement that the ILIT trustee had the sole power to end the split dollar agreement, not Marion's trust. And so because all the assets in the ILIT were outside of Marion's estate, that power was not a power that Marion had. And therefore, because the ILIT trustee could decide if and when to terminate the split dollar agreement, the fact that Marion had no control over the timing and, in fact, the value of the policies that would ultimately be received, the court decided that a discount of the cash value was appropriate in valuing the assets in Marion's estate. So the IRS lost and the taxpayer won in the decision in the Levine case. And so what are the takeaways that ought to be taken away from this case? Well, I think one takeaway is the Levine decision was favorable because the taxpayers took some care to avoid the pitfalls. They didn't give Marion's revocable trust the power to end the split dollar agreement and basically demand all of the policy's existing cash value because the Levine revocable trust had no power to control the timing of getting the receivable. The court decided that a discount was appropriate. The Levine case is also reassurance for us that we've still got some ways to use split dollar in the life insurance business. It still works in the employment situation and in certain family situations. And it's a strategy that needs to be considered in the right kinds of circumstances. The tax court implicitly blessed just about every recognized split dollar design in its decision, because it applied the principles in the regulations. It recognized that private split dollar works, and it recognized that multi-generational private split dollar works as well. And so all of that is good news for us. And opportunities exist, where we run across them to implement multi-generational high net worth situation split dollar cases if they can help us achieve our estate distribution objectives. Doesn't come up that often for a lot of us, but where that situation does come up, it's certainly worth thinking about and certainly worth talking about. And I'd like to thank you again for joining us today. And I will turn the program back over to Amber to close us out. Amber?
Thank you for joining us today. As a reminder, if you would like to receive supporting materials, feel welcome to email us at asktheexpert@advancedunderwriting.com. You may also email questions related to today's webinar. Feel welcome to join us for the next webinar on the first Wednesday of next month, November 2nd, at this same time. Next month's webinar will be titled Case Study, Business Continuation, and the Broncos. You can also find an archive of past webinars on our YouTube channel, Advanced Underwriting Consultants. Please subscribe to our channel. It helps us to keep making free webinar content. Today's presentation will be posted on our YouTube channel by the end of this week. Finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact us at 615-224-1291. That's 615-224-1291. Thanks again and best wishes for continued success.